I have 500 rupees and I want oranges and apples. Sir, for rupees 500, you can have an assorted fruit basket of a bit of every fruit.
That's exactly what an exchange-traded fund does. It gives you access to the whole basket when you choose an ETF. Aim to enjoy the fruits of your investment. Invest in ETF. Smart option choose karo. ETF karo. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Hi, everybody. Welcome to this special webinar that we're doing in association with Money Control and Mirai Asset Management. And the focus is going to be on passive investing, particularly on ETFs. Well, why is that? You know, one of the many long-term trends that's shaping the global investing landscape is the rise of passive products. And, you know, even in India, the first ETF was launched in 2001. And in the 20 years since, the industry has grown to what a shade under 3 lakh crores, but that's 1/10 of the total pie of mutual funds, which stands at about 30 lakh crores, right? And of course, if you look at the global numbers, the global assets would be well in excess of $5 trillion. So, you know, we're a very, very small part of that right now, but definitely it's something which is seeing a snowball effect. Now, within the passive landscape in India, it's ETFs which are the dominant player right now, right? So almost, you'd say, 9/10 of the passive pie in India would be ETFs. And within that, it's index funds which are the leader right now, right? More than half of the assets under management in ETFs are in index ETFs, right? So, you know, why is it important to have ETFs in your asset allocation? That is the topic that we're going to be discussing today. And joining me is Siddharth Srivastava, who's the head of ETF product at Mirai. Siddharth, thanks very much for joining us. And, you know, first to begin, can you just set up where the ETF investing trends are currently? What are you noticing from what people are telling you? And what is the kind of growth, or what's the landscape that you're seeing?
So first of all, thank you, Sumaira, for having me here. So I'll stick to the Indian context only because that will be more relevant. So as you rightly mentioned, the current AUM of ETF industry is around 2.7 lakh crores. But it is still predominantly driven by PF investments in Nifty 50 and Sensex ETF and government-driven CPSE and bond ETF. But last year or so, we saw significant amount of inflows in gold and foreign ETF. We are increasingly seeing more and more retail investors, HNI, family offices transacting in ETF, growth in demat accounts, investor education around ETF, very low cost of ETF, and underperformance of mutual funds versus the benchmark has certainly helped here. But it's a long way to go, but it's always very encouraging to see the increased amount of participation from retail investors while institutional investors took it up a while back. We are happy to see more and more retail investors participating. From a product point of view, very interesting developments have taken place in last 1-2 year. We are seeing increasing traction on target maturity based debt ETF, product based on foreign markets also being filed by the AMCs and being queued for the launch. See, it's easier to come out with an exotic product on the ETF or a passive product side than compared to mutual funds. So I guess I will continue to see more and more product innovation on the ETFs compared to mutual funds as each AMC tries to create its own niche in this particular segment.
But, you know, Siddharth, I take your point that there is scope for innovation, right? But as a consumer, you know, what used to happen with active funds was that, you know, there were so many that as an investor, we don't know what to pick, right? I mean, the fear now is that will the ETF, market be too crowded for retail investors to actually understand what's best for them? And, therefore, what are the best practices for choosing an ETF? I mean, how do I know, what works best? How does it fit into the portfolio? And how do I know the exit opportunity in an ETF?
Sure, I think that's a very right question. In fact, there are more than 7,000 ETFs globally, and there have been conversations whether there are too many offerings on the ETF side also as there has been on the mutual fund side. But see, what ETF does very differently is that it's always very transparent in nature. It has an investment objective, it has a known method, and it basically tries to stick to that. So if a person wants to take a long-term exposure in a very broad-based index, he can very well go for Nifty 50 or a Nifty Next 50 or a Sensex ETF and get that large cap exposure. Whereas if an investor wants to go, let's say, a more tactical and wants to, let's say, as of now, invest in CPSCs or PSU banks, he can invest in those ETF. Whereas, for example, globally, while it's still coming to India, globally, a lot of people are investing in AI sector based ETF or a cloud computing sector based ETF through this vehicle only. If you want to have a very targeted exposure to a very niche segment, also, that is something also which ETF can provide. So, while the number of products in ETF globally is very huge. I think it will continue to grow as new economies, new technologies come into picture. For example, EV based electric vehicles based ETF is getting a lot of traction now because of the kind of run up which Tesla has. So as long as more economies, more sectors, more themes continue to appeal to investors, ETFs will be more in forefront to get that AUM, get that market compared to mutual funds. And I think product innovation will continue there, but very rightly said that there may be a problem of plenty. In that case, retail investors should ideally, basically, first of all, align and see that his investment objective, his risk and return profile is aligned with what ETF is giving, right? For example, in a large cap segment, investor can invest in these broad-based ETF Nifty 50s and get the overall cost of his portfolio low. He can reduce the fund manager risk in his portfolio and continue to get market segment returns, at least in, let's say, in large cap or banking, etc. We very well though believe that active plus passive is the way forward. So investors should not ideally be choosing active or passive. It should be always, and how do I merge my active allocation with passive allocation, and something like 20% of allocation in these segments may be a very good starting point for investors.
Okay, I take that for an early investor, right? But what is the trend globally? I mean, how are people using ETFs in their portfolio? And I remember last year sometime I had done this show where I explored the idea of a three ETF portfolio, and I had called it radical. And then somebody chided me and said that it's not really such a radical idea because it's happening globally. So what is the future in terms of what are people already doing in developed markets, in developed passive markets, and how much of it do you see coming to India?
So, in terms of usage, global markets are fairly evolved. So, one very simple thing what they do is take long-term exposure through ETFs, even tactical exposure through ETF. See, they are very conscious about the cost. ETF products which are available at just 5-10 basis point, 0.05 or 0.1%, it becomes very competitive where alpha which is being generated in global markets like US, it's very low. So cost becomes a factor, and that's why they invest in these broad-based indices and sectoral indices from a long-term point of view, from a short-term point of view, through ETFs only. But apart from that, globally, what has also has been happening is that a lot of international exposure, and I'm sure you're well aware about it, that if foreign investors want to invest in India, they will typically go for an India-based ETF, or if they want to invest in emerging markets, there's an EM ETF in which they will invest. So a lot of international exposure is also happening, is being taken up through ETFs only. While there are multiple complicated strategies which they are doing just to reduce the cash in the portfolio, they take beta exposure of the market. During the rebalancing also, they prefer ETFs just to have that beta exposure and not to, let's say, let cash sit idle in their portfolio. On the innovation front, I think we've already covered that there's a lot of demand on thematic ETFs. So, in fact, that point where you mentioned that why don't we come out with a product which incorporates multiple ETF? I think Sumaira, you had a vision for the future because recently in last 6 months there have been a lot of fund of fund which basically invest in multiple ETFs and fund of fund and provide investor a single avenue of investment to take exposure in multiple ETFs. So he doesn't have to worry about it. AMC has to worry about it, and it's a very convenient vehicle which has now come in the market. So you were right there. Why don't we come out with a product which has multiple ETF underlying?
Siddharth, the other thing is this, you mentioned, that probably an ideal allocation currently is, say, 20% in ETFs, right, in a person's portfolio. Would this be more tilted towards large cap ETFs or, perhaps just a fund of fund and put all your 20% there?
I think that's a very good question because when we talk about ETF, we talk about in a very generic manner. But what investors should note is that in which segment of the market there are efficiencies, and mutual funds are maybe not able to generate that much alpha, and benchmark itself is able to capture market in a very agnostic manner, in a very true manner. So, for example, in large cap space, small cap or mid cap category, or even healthcare, though there is no ETF on that, there we still see that mutual funds are doing fairly well compared to their benchmark. And maybe passive investment in those segments doesn't make sense. So it depends what the investor objective is. We always say that invest in segment of the market through ETF where the markets have become more efficient, large cap category which is, and if you want to take a very focused exposure, for example, right now, people are talking about investments in CPSCs and PSU banks, etc. Maybe in for next couple of months of a period because of the kind of few people have. So there you can take a very focused exposure through CPSC ETF or a PSU bank ETF. You don't have similar offering on the mutual fund side. So I think it needs to be carefully looked into on which passive product makes more sense for you, rather than blindly believing that passive products across all these segments, all these sectors have efficiencies compared to active products.
Fair enough. So if by and large, the at least entry level investors, right, or if somebody is moving into ETFs for the first time, if the call is that, if you must take one ETF, then choose a large cap ETF or index ETF, right? But the thing, the peculiarity with the Indian market is that the large cap stocks is just the top 100, right? And in any case, large cap funds is the largest category. And, even if you take something like a flexi cap or whatever, there's just too much money chasing large caps. Is that a big risk for these kind of ETFs? I mean, what are the risks associated with an ETF?
I think for, let's say, a simple Nifty 50 ETF, in fact, you'll be surprised to know that the biggest fund in India is a Nifty 50 ETF. And not a mutual fund. So risk for such products for a Nifty 50 ETF is similar to a market risk. Let's say if there's a liquidity issue in a large cap, which is not there as of now, but that will be true in the case of mutual funds also. It will be true in the case of ETF also. ETF per se have higher weightage towards more bigger companies because they are uncapped weighted, and that is why I think that risk in terms of replication, in terms of buying and selling, may be lower in ETF. That's the way they are constructed. Whereas in case of mutual funds, if fund manager has high weightage towards smaller large cap companies, he might face issues. But for example, these broad-based indices are constructed in a way that it reflects the liquidity of the Indian equity market. So the risk of these ETFs is similar to what the risk of Indian equity markets are.
Okay. If we assume, and it's not wrong to assume, that the mutual fund industry is growing, right? It's 30 lakh crores now. And we are working with the assumptions that passives are going to play a big role going forward. Will passives be taking money? I mean, and I'm assuming that the pie is growing continuously, right? The overall pie. Will ETFs or will passive products will be taking share away from active mutual funds, or do you think that's an entirely new market that's going to keep developing simultaneously?
No, I think there'll be some amount of money which will be taken by ETFs from the mutual fund, especially let's say in some of these space, in let's say large cap space, where people uh, are observing that there are a lot of large cap funds which are struggling to generate outperform the benchmark on a consistent basis. There was one study which we did where we saw that in if you're looking at funds which are in Q1 in quartile one, there are 7 funds in large cap space at any given time. Let's say we are in Q1, it on an average 4 to 5 funds move out of quartile one and move to a different quartile because of underperformance, because these funds typically continue to have a cyclicality. If you look at last 5 years, there was no fund which was Q1 in any of the last 5 years consistently. As people observe that, I think, especially in the large cap space, ETF will eat into the market share of the mutual funds, because see, ultimately it's a very low cost tool. uh, the costing is so less, and when with low cost you're getting returns also, then why not people will choose not to invest in ETF? There are a lot of DMATs accounts which are opening up now with the advent of a lot of these discount brokers also, which are becoming so huge. People, the transaction cost which was associated with buying and selling of ETF has also gone down significantly. I think all those will combine, and I think ETF market will eat into the market share of mutual funds, especially in large cap space. But apart from that, I think foreign ETFs will create an own niche. People, there have been a lot of interest on the Nasdaq 100 and S&P 500 and other foreign indexes also, because of the kind of return which US markets have generated. And lastly, as I mentioned earlier, that there's a lot of traction on the target maturity based debt ETF. People try to compare it with FMPs and invest in these products instead of as let's say substitute of FMP. So there'll be some share which will go in these target maturity based debt ETF, which are actually gaining a lot of traction. So I think it depends in which segment you're talking about. It will though eat into the returns, but some will create niche of its own.
I noticed you didn't mention gold anywhere, which for the longest time in the Indian market, at least, the gold ETF was a strong player. Is that a trend, or I mean, is that done?
No, I think in last 2 3 months also we have seen a decent amount of inflows. In fact, in last 1 year, I assume that there was an inflow of almost 7,000 crores in gold ETF. Only in last 3 months, around 800 crores. So gold ETF is something, one segment. While the inflows may mellow down now, but uh, people have Indians love gold, so I think inflows will continue to happen, though not at a significant quantum with what we saw in last 1 year or so.
So that the whole philosophy of ETF investing was to keep it simple, right? But is the focus increasingly now towards innovation or exotic? I mean, I noticed you use those words a lot. I mean, is there a contradiction there?
I think there are two ways to look at it. Globally, people are talking about active ETFs. They are talking about smart beta ETF, factor based ETF, but they have had their journey of 10, 15 years where people invested in plain vanilla ETFs only, international ETFs only. And then moving on towards these exotic products, like as I mentioned, active ETFs now are becoming very popular globally. ETFs around smart beta factors, etc. In India, we are, I think, doing product innovation in parallel with the market still developing on the very plain vanilla products. For example, we would rather, I think, like to see more retail participation on Nifty 50, Sensex, Bank, and Next 50 ETF. But while we try to promote it, we are also trying to create more smart beta products for Indian investors, more thematic products for Indian investors, because because I think market in India is still very distribution driven. So to attract investors towards the passive side, you also need to talk about good products, innovative products, so that people are willing to hear you out on what the passive products are, and then obviously uh, push in the large cap ETFs. Also talk about the large cap products also on the ETF side, and tell them what the benefit of these products are for their portfolio.
Yeah, no, I take that point entirely that, distribution is a challenge for a product, where the ultimate aim is to keep costs very, very low. But Siddharth, having said that, some ETFs, I mean, but correct me if I'm wrong, but we have what, less than 100 ETF passive products in India, right? And even within them, if you see, some of them have a market share of, not even 0.5%. So is it that there is products are being launched with the aim that there should be variety available for investors, because anyway it's a low cost product, so there's no harm there? Or, I mean, is this the stage being set for the future?
I think, as I mentioned earlier, predominantly the investments, if you're just looking from an AUM point of view, is happening because of the PF investments in Nifty 50 and Sensex ETF, and that is concentrated in four ETFs only, as well as the CPSC and that ETF, which is government driven. If we remove that, I think AMCs are launching ETFs because first of all they want to have a foothold in this market. This is something which a lot of people believe is for the future. As Indian markets grow more efficient, this is somewhere people will come in and invest, and the market share will increase. I think launching of, let's say, a gold ETF or a Nifty 50 ETF or a Sensex ETF, maybe it's more of a Me Too space where everyone wants to be there, because I think there is a longevity in these products. But I think now, especially in last couple of years, a lot of AMCs are trying to create its own niche. Some are focusing on sectoral ETFs. Some are focusing purely on index fund for just having all the products so that investor can create its own model portfolio. Some are focusing on debt ETFs. Some are focusing on 40% of my portfolio is into ETFs. Out of 40%, 10% will be in Nifty Next 50 and 30% will be in Nifty 50.
Okay, fabulous. And anything else that you want to advise viewers, about when they're selecting a product? And, a lot of people also ask, ETF or index fund, how should I choose? So anything that you want to tell people about, when they're going to make their investment, what they should keep in mind?
What investor, or specifically retail investors, should note while investing in ETF? One is always invest in ETF which is liquid and which has a healthy order book. I think more prudent thing will also be to check for the tracking error if ETF is tracking the underlying index in a better manner. But I think that data is not readily available for retail investors. So what you can look is see if the ETF returns for past 1 year, 3 year is in line with the benchmark return which it is supposed to track. One very important thing is that investors should always check the real-time net asset value of the ETF on the AMC website, just to be sure that whatever price he's getting on the exchange is fair and is correct. I think a lot of AMCs, including ourselves, are publishing the real-time net asset value, which is updated every 5-10 seconds. So that's a very good post to compare the exchange prices to. And lastly, always use the limit order. Don't use the market order. Once you know what the real-time net asset value is, use that as a benchmark, use it as a limit price, and then transact in the ETF. So that is something which retail investors should note, should be conscious about while transacting in ETF. Lastly, on the index funds versus ETF, I think that is one debate which is never going to end. Both are passive products, both track the underlying index. We firmly believe that if you are able to transact ETF at a lower cost, at a intraday net asset values, it becomes a very compelling product, because unlike index funds, which can only be transacted at the days in NAV, like mutual fund, in ETF you can always enter and exit based on the intraday net asset value, just like stocks. So and also typically, apart from, let's say, uh, apart from a plain vanilla benchmark, typically the cost of ETF is lower compared to index fund if you're comparing the exotic products. So there are a couple of points, I think, but it's up to the investor to choose. But we firmly believe that ETF remains a very compelling product on for the passive investment if you want to go
Fair
into that
enough.
space.
Siddharth, I know I felt like I'm asking you to choose between two children, but you've given a fair comparison. Thank you very much for your time and for explaining, the world of ETFs, which for Indian investors currently is still, something that we're grappling with trying to understand. So thanks very much for making it so.
Thank you, Sumaira, for having me here.
All right. I hope you enjoyed this webinar, and I hope you've taken some insights from it, and I hope it'll help you in your own ETF journey. Thank you very much, everybody, for watching.
Mutual fund investments are subject to market risks. Read all the scheme-related documents carefully. Mutual fund investments are subject